right, now we're going to talk about sales transactions. So sales transactions, we've been buying inventory. Now we're finally going to get to sell some of our inventory. So one thing to note about this is that they're always going to affect at least 4 accounts. And that's because we're going to do 2 things. We're going to record the sale in the first 2 accounts. And then we're going to record the movement of inventory. That is moving it out of inventory because we sold it and into cost of goods sold. That's our expense. All right, so let's see what they're going to give us. Sold merchandise for cash, $25,000. So what did we get? We got cash. How much? $25,000. What do we do to get that? We made a sale. We're going to call our revenue sales. All right, so that is record the sale. Now let's record us moving it out of inventory and into cost of goods sold. So cost of goods sold is an expense. Expenses always go up with a debit. And so we can remember that by saying after eating dinner, let's read comics. So this is our expense. So expenses go up with the debit. All right, so cost of goods sold is going to go up with the debit, and it tells us how much it is. It tells us it was $17,500. And because our customer bought our inventory now needs to go down because they took it out of our store. We don't have it anymore, so we need to credit it to make it go down. So we credit inventory for $17,500. And that's how we record a cash sale. So the next one is the exact same, except for instead of getting cash, it was on account. So instead of debiting the asset named cash, we debit the asset named accounts receivable. All right, and we got that again by making a sale. So that's sales. That's our revenue account. They told us that we made sales of $98,000, so we're going to debit accounts receivable for $98,000, credit sales for $98,000. Next, we need to record us moving it out of inventory and into the expense named cost of goods sold. So expenses always get debited to increase them. Cost of goods sold. And then we're going to move it out of inventory because the customer took the inventory. So our inventory decreases and they tell us $58,800. So we'll debit the expense and credit the inventory. And that is how we do that one. Sold merchandise to customers using MasterCard. So our customers used, MasterCard and Visa, a credit card. Well, right when they swipe their card, it charges them, and right away it puts the cash into our bank account. So whenever you see a credit card sale, we're going to consider it a cash sale. Credit card sales are cash sales. So what does that mean? That means that we will debit cash because we got the cash right when they swiped their card, and sales by that sale amount. They tell us it was $475,000. And then the movement of inventory means that our cost of goods sold, expenses go up with the debit, and our inventory, we sold it, it's gone, we credit it to reduce it, $280,000. The next one is the same thing except for they use American Express. Well, guess what? It's going to look the exact same as the top entry. It's going to be a cash sale again. So I'm not going to write it out, but it will look exactly like that with the new numbers. Cash sale again. Now let's go down to the very bottom. We received an invoice for $13,400, and it was for a service fee that we paid. So we've already paid it for using MasterCard. So this is just a selling expense to us, and we're going to call it credit card expense. Expenses go up with the debit, so we're going to debit $13,450, and we paid it, so we're going to credit cash to show that our cash went down because we paid that amount of $13,450. So this is an example of how to do sales transactions in Cengage. Let me know if you have any questions.